Hey, welcome to the Closing Beat, everybody. Happy Wednesday. How we doing out there? Oops. Good? All is good? Glad to hear it, man. We are financial advisors here at Jazz Wealth. Hope you check us out at jazzwealth.com and all that good stuff. We're going to talk about the stock market today and maybe some other things as well, because advisors shouldn't just be always talking about investments, retirement, right? What else is there? There's got to be help in the personal finance space, the taxes space, the wealth building space there. And we get all kinds of cool questions like that. So happy to help. Anyways, let's look at the stock market here. What do we have today? The market moved lower. Ask yourself, why would the market go higher today? So really the thought comes from yesterday where we talked about the risk to reward. If you were someone who was looking to buy yesterday or today, you can't justify that purchase unless you're one of those sneaky people that does not define your risk. How many of you have bought a stock, built a portfolio, bought a mutual fund, whatever, maybe as a midterm investment, short-term, long-term, whatever, doesn't matter, and you didn't decide how much you were willing to lose? I've done it, right? Everybody's done it. Well, if you look at the stock market here, anyone who decides that they know what they're willing to lose has to take the risk down to here. Really, that's all they have to work with. Risk is this wide, reward is only this wide, right? Many multiples, like we talked about yesterday. So that's the real simple way to look at the market and go, well, yeah, we have some resistance and normal technical patterns that people like to look at, but generally speaking, you can't convince somebody that it's a worthwhile risk. Well, okay, let's put that aside for a second. So the market has to go higher at some point, doesn't it? What will it be that eventually convinces people that, yes, the reward is worth it? Let's go on above this trend line, the 200-day moving average, maybe head back towards these highs. What's it going to take? Well, we have to reduce the risk, right? You have to give someone an incentive to take the risk that it will break above it. How can you do that? You reduce their stop loss, or in this case, reduce the amount of risk that they have to take before they see or can find out if they're wrong. So if I told you that, can I draw on this thing? There's a square, right? So if I told you that you're going to risk this much, right, in order to gain this much up to this prior high here, would you take that trade, right? Probably. Right? That's a 2-for-1, right? Roughly somewhere in there, 2-for-1 trade. But right now we just don't have that there. So what does that mean for the stock market? Okay, we have to set a new higher low. We have to consolidate sideways to where people feel that their risk is now much smaller. I guess I can't change. Yeah, there we go. So if we make a new higher low, look at that. Now you're in here somewhere. Okay, cool. Now you can convince yourself that the risk is worthwhile, because if it doesn't break this downtrend, your risk is smaller, right? Now that only works if you're willing to define your risk. I've actually done a couple of great videos on this, and we have a spreadsheet. It's a trade tracking spreadsheet, really extreme spreadsheet, but you don't have to use the whole thing. But it's in the dojo for clients who want to download it. But what it does is it determines the multiple of risk that or the multiple of your reward compared to your risk, right? So you can figure out, can I take that trade? Can I invest in the S&P? Now, take it even further. You're trying to convince not just yourself, you're trying to convince all the market participants that that's a worthwhile trade. Just wasn't there today. That's the simple answer, and the short answer is there's just not enough meat on the bone for somebody to say that's worthwhile. Let's make the bet now that we're going to go up here. Well, why not wait? There's almost nothing to lose by waiting there. So that's what you have going on with the S&P. The Fed, now you got an 85% chance of a 50 basis point hike in December. So we'll find that out in That's December 16th, December 13th. Someone will clarify that. But the belief is that the rate hikes will start slowing down after that. I do want to point out home builder sentiment. Lower again. Home builder sentiment down. That's going to be 11 months in a row that home builder sentiment has fallen. That is by far an all-time record, right? Like 7 months in a row was the previous record. So hands down an all-time record and by quite a bit. So why aren't the home builders falling? That's interesting. Well, this is the home builders ETF, but let's look directly at the home builders. You could use something like the ITB. This is in the pure home construction space, whereas the XHB has like Home Depot and Lowe's and things, so it could be a little bit skewed. But still, barely fazed by that news. In fact, much stronger, or has been stronger than the market this year. What's going on there? We talked about that yesterday as well. Fascinating to watch that continue to happen, right? You would think that would just be falling apart at the moment. So that's a great lesson, sort of in real time, to kind of learn about that one. Anyways, let's move on here. The risk to reward lesson is good there. That was obviously very clear now if you've been following for the past couple days. If we look at the NASDAQ here, really keep in mind like the magnitude of the volatility in the markets right now. We've become accustomed to it, right? Does anybody remember when we were going through like 2019 towards the end of it, and then we started getting towards the start of that COVID mess? Remember how quiet the markets were? And then they woke up, had this massive like COVID, burst, right? And it felt like the world was ending because we just came out of this period of sleepiness. That is truly like you've been sleeping all night, and somebody lights a firecracker, right? You wake up and you think something's worse than it really is because you were at this level of calm throughout the day, right? That's where we went. I say that because if you look at the NASDAQ, in just 5 days, just 5 days, it's traded just about half of its yearly average gain. That's intense right there. Right? Yearly average gain, just about 17% if you go back as far back as you can, as long as the NASDAQ 100 has been around. That's crazy. In 5 days, you have that level of performance. That is the definition of a volatile market. So keep that in mind. You're living in these wild times. So when we get into Thanksgiving week, Christmas, the week between Christmas and New Year's, when we get into that week, if nothing's happening, that's normal, right? That's a quiet market. So don't let it cause you to do something you shouldn't. The Dow actually keeps having these days. This is why the Dow is only down about 7% year to date. This is exactly why. It keeps having these days where the rest of the markets lose 0.5%, 1%, somewhere in there, and the Dow's like flat. Nothing, right? So very interesting. Today, obviously being held up by United Healthcare. Remember, the Dow is price weighted, so the bigger the price, $500 stock is going to outweigh a $50 stock. So a little bit of help there with United Healthcare. Oh, McDonald's as well. I wrote down. Let's see what's going on by the end of the day today. Yeah, strong day for McDonald's, doing good. Man, like Home Depot, right? They just reported earnings and stuff, but that helped offset some of the names that were weak today. Salesforce just didn't do too well. It's a $155 stock, right? So United Healthcare can go up $1. Salesforce can go down $1 or a percent. I should have said a percent. United Healthcare up 1%, Salesforce down 1%, and the Dow would still be very positive for the day, right? Salesforce is a smaller stock. Anyways, having a bad day there as well as CVX, really anything related to oils. Not much need to spend time on this area. It's just been very strong. These are your leading stocks in the oil space. Chevron, ExxonMobil, they're the largest as well. And they're just pulling back there a little bit. Looking around, I said oil, so we'll give oil a second here to talk about that. A little bit of a pullback. Inventory levels a little bit higher than expected, and that goes in, that's consistent with last week's report as well. Higher inventory. So it's either A, we're slowing down, or there's a ton of oil out there. It's not the latter. It's the slowdown. So got a little weakness in oil, at least for the moment. We'll take it, right? Bitcoin, I don't know what's going on over there. This is what I don't do Bitcoin. Never have. You guys notice it's not my thing. But it's a wild ride right now, and I just have to point out something really quickly. I'm a fan of Morgan Brennan, right? I mean, you guys, that's not a secret there. She's my favorite. And she had the CEO of Strike. It's like a crypto lending kind of a thing, right? That you can essentially access capital, and presumably, at least it was, that you would pay less than using a normal dollar. And it's supposed to be secure and all this stuff. Well, all these crypto people are coming out of nowhere and just being like, hey, it's fine. It's safe. Don't worry about us. Can I show you this picture? I've never taken a picture of a TV before. And I saw this and I'm like, is that the best thing you could have done today, bud? So let's go over here. Here's the picture. So the guy's name is Jack Mallers, right? He's the CEO. Okay, I get the hoodie thing. It's cool. The kids in crypto all wear their hoodies. Anybody notice what's going on in the background? You're trying to convince people that your money is safe. Everything is good. Don't worry about it. And he's clearly in a very nice closet, but the closet has nothing in it. Am I wrong for being like, okay, you got one hoodie on. You have nothing anywhere in your closet, your mom's closet, whoever's closet this is. There's not so much as a shoe on the shelf. So I thought, well, maybe it's some sort of like closet design store, and he was just shopping for a closet. And so he's like, okay, we gotta do a video. Maybe he got a last second invitation on CNBC. No, because in the closet stores, they at least decorate their shelves. So yeah, your money's safe with me. Don't worry about it. But I'm going to leave this place at any possible second. It looks like he's literally about to put that hoodie on and go running away. So I just thought that was funny. Maybe I'm reading too much into it, but what? Let's try to set a little bit of confidence out there, huh? Anyways, our Wine and Wealth class 2 weeks ago was actually on the Augusta Rule. If you've been seeing that online, we went through the details. We give you a package. If you're a client of ours, we actually go through step by step. You have a package. You know how to do it. Please make use of that while you can, because 87,000 IRS agents will want you to be doing this specifically right. If you don't do it right, you do not get the deduction or the write-off in your business as well as yourself personally. So take a look at that. Sector-wise, I'll just point out a couple things. I won't spend a lot of time here with it today. You probably got things to do and whatnot. Utilities and consumer staples were the two only positive sectors on the day, which interestingly enough, these are, if you take energy out of it, these are your two best performing sectors for the year. Naturally, energy is on a planet on its own there. These two are the best, and they're continuing their strength. So just wanted to point that out. Both of them are only down about 2% year to date. Consumer staples and then utilities as well. Not typically an exciting area to invest, but you got to recognize the strength, and you may be wanting to make sure you have a little exposure to that. All right. Little side topic real quick. We talked yesterday about how companies, the big public companies, handle their finances, right? Meaning through different economic cycles, we're going to handle our approach to our finances a little bit different. And I shared this with you over here where we talked about, and I'll just get that out of the way. We talked about during different cycles of the market, they literally, it's just a simple cheat sheet. I mean, they obviously think about it more detailed than this, but this is exactly what they do with their money. So if you want to check that out, just go back to yesterday's class. I want to take it a step further because you guys aren't doing what they're doing. So we made the argument that you should handle your money about the same way as these companies do. Take every advantage you can, though they will be different, and we're likely working with smaller digits. Go ahead and do it. New York Fed puts out their study. They do this every 8 weeks, I believe. No, 16 weeks, something like that. That's not a monthly thing, I don't believe. Their study shows that you're doing it backwards there, right? Let's start with this. The number of mortgages that are delinquent by 90 days or more, meaning you've already missed the first payment, you are now delinquent, you have crossed over the 30 to 60 day window, you are now what's considered severely delinquent. Trending lower, right? Historical lows. That's very nice to see. Okay, cool. No problem there. We're paying our mortgages. The number of mortgages delinquent 30 to 60 days, right? So now we're saying how many people are maybe a little bit behind, but not as far behind. That number is trending lower. Okay, nice. Keep in mind, I'm looking through, this over here is the year 2000, right? So we're going 2000 to 20, so we can just see, okay, those are historic lows. That's very nice, right? Now, how about what's known as the transition rate of people that were current on their mortgage and now they're 30 to 60 days delinquent. So I'm going to change this to original. We're going to pop out of here for a second so you can see just those people. All right, let's look and see. You were paying your mortgage and right? It's a little off the screen. Let's come up in here. Just zoom up a little bit. All right, let's take a look. Oh boy, going the wrong way, right? So people that are 90 days delinquent, 30 to 60 to 90 days, okay, you guys are doing just fine. But what's that tell you that the people that were current and now are getting delinquent is getting a little rough? That means that transition rate to 30 to 60 days, 60 to 90 and 90 plus, all of a sudden we might see some longer term issues there. So heads up on that one, and I hope you're able to pay your mortgage. But the point that I wanted to make was right here, the study from the Fed. So what's happening here? Do you know what this is? Oh no, this is total credit outstanding, revolving credit. So I'm going to zoom into 5 years. We know that things are slowing down. Everybody and their mother's like, oh, there's probably going to be a recession. Yeah, it's probably. What are you spending more for? Stop it. You're doing the opposite of what these guys do over here. These guys say, oh, we have a slowdown. We need to strengthen our balance sheet and return cash to shareholders. You being the shareholder in this case, right? Investing for growth, spending money and all this stuff. Well, that doesn't occur when the economy's slowing down. So please think about that. It's time to slow down a little bit. Worst case, you're wrong and you get to buy things at a discount. But just wanted to point that out because you can see the data. It's not my opinion. I can see you're spending money, right? Okay, it's like trying to tell a teacher you did your homework and you submitted it online. Well, there's a date and time stamp on there. We can see that that's definitely not the case. Yep. Somebody's going to be mad that I said that. All right, Winnebago, over here. Stocks in the news, and we'll get out of your way. Winnebago, $5.5 billion strategic plan to help their revenues there and grow their gross margins. Nobody seemed to care today. It's a very tough business to be in right now. I mean, it has been too, since, aside from COVID. So they've done fine, but now they got to start saving some money. Well, what does that mean? It's a strategic plan to improve their balance sheet. Is that one of the check marks over there on the other thing? Let's go check. Let's refer to the CEO chart. Balance sheet strength in a slowdown. Yes, we want to do that, right? Look at that. Every one of you could be a CEO right now with that. TJ Maxx. Ooh, lessons in real time, right? Check this out. Why is it doing so good, right? They just said 6 weeks ago in their conference, they did a retail conference, or they were a part of one, and they just gave you the insight to what happened today, right? That's all you had to do was just pay attention to that conference. They literally said everything they needed to say. Management says, our capital allocation priorities rank as follows. Number 1, investing back into the business, cleaning up our stores and stuff like that, so we can save money there. Does that fit the checklist, Bob? Yeah, it fits the checklist. Number 2, dividend growth. We want to target our payout ratio to be 40%, meaning they want to pay more dividends. Does that return cash to shareholders? Yep, that's on the check. They're doing it, right? And finally, number 3, share repurchases. Let's see, returning cash to shareholders. Yes, that's all. We can verify. The CEO is doing exactly this right here, given that we are here in the economic cycle. Are you tired of me talking about this yet? Very fascinating. They also talked about their inventory. Very fascinating if you look into their inventories of how they're not trying to compete on a lot of stuff. Although they're a discount retailer, so you think they'd be competing. They're done with it. We're keeping our margins high. We are returning cash to shareholders, putting money in the bank, and just taking a minute to improve our stores a little bit, keep them smelling good and whatnot. All right, Disney's in the news here. The company announces that prices are going up. Buy your tickets before December 9th, I think it was, and you won't have to pay the higher ticket prices. It might have been December 3rd because I have 9 stuck in my head. Prices are going up 9%. Well, that's more than inflation. How are they raising it more than 9? Whoa, they just picked 9%. So prices are going up there. Don't go to the parks right now anyways. They're so freaking busy. Discover Financial. Well, this stock is doing well. It's outperforming here in the short term. What just happened there? They're going to do $4.2 billion in share repurchases. Well, you guys know we got to refer to the sheet. Let's see. We're here. Return the cash. Yep. Okay. That's what it is. So why is this stock performing so well lately and actually outperforming the market? Now you know, right? I joke about it, right? I'm just having a good time with you guys, but you see what I'm saying? It's out there every day. The news is out there. If you know what people are looking at, or if you just watch the show, you know, it's good to go. Target pretty bad here, and we talked about this a while back that they are going to have issues with inventory. I wish I remember the date. Somebody, if you know the date, then we'll send you a gift card, right? Look back at the date where we talked about Target having an inventory issue and how that's only going to get worse through the holidays because they already placed their orders for the holidays. So think about that. The store's already kind of filled up, but we have shipping containers coming over with more and more stuff for the holidays, but we already have a bunch of stuff. More stuff. What's that mean? We got to get rid of some of that stuff. Prices have to come down. There has to be sales. We got to push things out the door. And so part of that, in addition, well, part of that caused them to lower their guidance going forward, which is, I mean, I don't want to say it's a no-brainer because they're getting hit like Walmart got hit in the last quarter, but they just got to get through the inventory. That's all it is. So if you're going shopping this holiday season, you might take a look at Target. You know what I mean? You go when you walk in and they have those rows with the baskets just filled with random crap. Hey, it may be cheaper, you know? So just friendly little personal finance tip for you there. So hopefully that helps. All right, we'll wrap it up there. Oh, by the way, there was one more. I didn't put it on the list, but I just caught this last second. Phillips 66. All right, keep in mind, this is a very extended stock. The whole sector is very extended. So I'm not saying buy the stock. I'm saying what I read through their notes. Let's see. They plan to return $10 to $12 billion in distributions to shareholders. Wow. Okay. From now through the end of 2024. So they're actually telling you how long they're going to be doing this. They are doing an incremental $5 billion share buyback plan. That brings the total number, by the way, to just about $7 billion. They're going to buy back about $2 billion in stock a year between, well, they've already done it this year, next year and the year after. Well, what's the stock doing here? Wonder why it's outperforming everything else. Remember, you can go back and look at all the shows that we've done there, but the stocks that outperform in almost every scenario or economic scenario is companies that return money to shareholders, right? Now, you're going to get a little bit less as we go through 2023, 24, thanks to the government deciding that they were going to do a surcharge on that, on buybacks. So agree or disagree, that's, you know, it's what it is. There's no way around that. All right, I'll take your questions if you have any, and then we're going to get on out of here. You eat at Subway, at Walmart. They still have Subways in Walmart? I remember that as a kid, but I don't think I've ever... I'm in and out. I'm a typical dude when I go shopping. Like, what do we need? I go get it. I'm going to get out of there because otherwise I buy lots of chips and it gets me there. What do we go? Weeks ago, everything was a buy. Now I feel more companies are extended. Yeah, there's a lot of sub-industries that are extended, and I'll give it oil as well, being if you want to pick the energy sector as well. I do agree. That's what happens with the general ebbs and flows of the market. You get pullbacks, discounts. Okay, well, I bought all the discounts. What do I do now? You get your rally. You go, okay, great. Oh, everything's going good here. I can't really buy now. Everything's extended. So you got to be willing to be somewhat counter trend there. Yeah, 62% of the entire Treasury curve is now inverted, and the repo rates as well. The Fed just crossed the 30-year today. Oop, where'd you go? Is this the biggest indicator for a recession? No, the 10s and the 2s, and they were inverted a long time ago. I think I did a specific video on that. Rest in peace, Harry. And rest in peace, Gallagher, man. I just caught that this morning. We lost Gallagher. Guy was still out there doing his thing. The chef is saying, is there a way to avoid the 10% penalty if you over-contribute to a 401k? You shouldn't be paying a penalty if you over-contribute. And it really should just be fixed automatically for you. If you're saying a 401k. Now, if it's an IRA, no one's going to over-contribute, or nobody's going to fix it for you, but 401ks should just cut you a check. You know? Yeah. You got it. I like it. I don't really care much for what happened in Poland, whether it was Russia or whether it was Ukraine. I don't have enough data. I'm a data guy. I don't have a way to access that data to see what happened, but otherwise I would. I'd be curious, you know? Yeah. An honorary watermelon for Gallagher. I like it. Awesome stuff. That's what I grew up on. Did watch a little of it, you know, pay my respects, watch a little bit of that from back in the day. Okay. I will wrap it up there because we will be back tomorrow to do it all over again. Love doing this for you guys. I love talking about the markets. Keep in mind, I'm no genius. This is just stuff that we're looking at anyways throughout the day. Stuff that I like to talk about. And if it helps you learn a little bit and you get a joke out of it or a little friendly laugh here and there, well, that's great. Because one day I'll probably say something to upset you, and I do apologize for that. Enjoy the rest of your day, and we'll see you tomorrow. Adios.